Thank you, Eve. Thank you, Tim. I'm glad our delegates and our participants have joined today's engagement just to learn more of ABC retirement solutions that we are so much glad to have to work with you and also to give the insights as you purpose to join retirement. One of the key things in terms of retirement or old age is the financial freedom. And when we talk about financial freedom, it means the capability of you continue paying your bills in retirement after having worked for so many years. So when you talk about ABC, I know this is one of the critical moments when you are making a choice, which way or which product do you desire or which option we are going to pick when you come time of retirement. So that's what we're going to highlight and share with you the insights as we go forward so that we are able to understand when it comes to retirement, which is the best model vehicle that will give you the best options and assures you a guarantee in your life in retirement. One of the challenges is that when you come to retirement, one thing you must have or must be assured is a regular income that comes to you without having interruption. We appreciate that this is the moment having worked, assuming that some of us having worked for more than 20, 30 years, and is the moment you need to make a choice and having saved for some money for your future retirement. Before we go direct to the options we have, and maybe we work together, is that we discover we have two set of schemes that are in place. We have the scheme that we call a pension scheme. Pension scheme, that one is a very direct one that says that upon reaching retirement, a member should buy an annuity or an income drawdown using his 2/3, whatever he has saved, and a third, he has an option as a cash lump sum. I have to mention about it so that we are able to know where we're getting this money from. Another option that is there in the industry is what is a scheme that's called Provident Fund. A Provident Fund by law and by regulation talks about a cash lump sum upon reaching retirement. Now, where we sit, all of us, let us appreciate that all these model, both a pension and a provident, enables you to have a decent retirement. But it's the decision you're going to make when that time comes in at age of retirement that's going to matter. And those are the insights I'm going to highlight. And also just to mention so that you can walk along with is that you can have saved money in money market, you might have saved money in property, and you can as well dispose and buy an annuity or an income drawdown. These two vehicles enables you to assure you a regular income, and shortly allow me to take you through the journey of the ABC, then probably from there we can talk. Now, I know most of you have heard about Octagon Africa, and we have been in existence for the last 18 good years, and our purpose as an institution is to journey with you as you continue saving and the time of retirement again. We don't abandon you. We have to work with you. We enable you make a right choice. Which model of investment are you going to enroll? And thereafter, we are able to make sure that you enjoy until God calls you home. And in terms of the content we are going to highlight, we are going to talk about retirement planning, retirement options, taxation on retirement benefits, and Q&A session. This is purely the engagement we're going to have, and I'm glad to take you through. Now, when we talk about retirement planning, just in a nutshell, where we are, because I appreciate we have various age sets who have joined today's discussion, is that how much do you need when you retire? This is one of the key things that as Octagon Africa will work with you and we encourage you to have a target when time of retirement comes. By proposal and suggestion, the expectation is that when the time of your retirement comes to play, the expectation is that you must have saved or whatever your take home as an income replacement ratio. The expectation is that you must have at least 75% of your income you're earning. That one may be coming from one rental income, may be coming from pension scheme that you have saved or any other investment you are having. So it's one of the key things that as you plan for retirement, then thereafter you join retirement, you must have a goal. And sometimes we discover that we have basically depended so much on the statutory deduction of NSSF or employer goodwill. However, as an individual, you must have a plan in place so that when that time comes, it's very key. You discover that how much do you need in retirement. One key thing, you must have expected lifestyle. Most of us, you discover that we have a lifestyle you're living now. So when you retire, which lifestyle do you require in place? Or do you want to enroll or continue living? So there is expected lifestyle. There's what we call medical conditions. That's one of the key things. You discover that when you grow old, our immune system becomes weak and you require more of medical attention and support as you continue living. Another thing is relocation and travel. I don't know if we're going to stay where you're continuing to stay or you'll have to move. That's how much you need in retirement. Another thing is a retirement home, whereby you don't need to be paying a rent, which is so key to us as we continue advising on a retirement journey. How much will you have? This is basically pension, because by the government law has given an opportunity to save through pension, and that's when we talk about additional voluntary contribution, whereby you can be saving for that future retirement. Transfer, personal pension, personal business is very key, and we usually encourage members that as you continue working, please try to set some time aside to make sure that we engage in personal business or personal development. Also, on how much will you have? This one is also purely on investment, and pension offers an opportunity to make sure that you save and you enjoy what we call compound interest on your investment. What income strategies are you best for you? Now, this one is whereby we're going just to highlight as then we go deeper as we continue our discussion. We talk about an annuity. Maybe just to mention, an annuity is a life product that a member buys with an insurance company to be paid a lifetime. A lifetime means until you die. I'll also be highlighting the benefits and the features of an annuity as we continue our discussion. We have an alternative of an annuity, that is what is called income drawdown. This is an alternative of an income annuity, and down this one, you put your money with an investment manager with an option, or you'll be drawing what we call income from it. So the money continue earning income, and where you sit as a member, you can only be withdrawing income from it. Then another thing also on the same, avoid the lump sum payment. That's another highlight we'll be talking about. When will you retire? Members who have joined us today, we are glad you are here. And something which is very key is when will you retire? In most cases, we discover most people retire when the employer term of retirement is mentioned. Some retire on different age sets, others retire in their own way. So this is another key perspective as you plan for retirement. This is a study that was done by Retirement Benefit Authority that shows that people in retirement, after having served or worked for their lifetime and have reached 60 years, 47% purely depends on relatives. Where I believe in the current era and age is that something we need to work it out so that we don't depend on relatives. Because these relatives might be your children, your siblings, and imagine you have been working, which is the highest number as per Retirement Benefit Authority. And through the learning skills and learning opportunity we have, we are able to make sure we reduce from 47 to the lowest number possible. We have some 35, 31% who are still working in their retirement. They have clocked, let us say, age 60 as per the government, and we discovered 61, they're still walking around looking for an opportunity or still working in their retirement. So just to make sure they sustain themselves. Purely these people, they may not have planned for their retirement. That's why they end up still continue working. 6%, as per RBA study and survey, confirms that 6% are independent, financially independent. They are the people who they are on their own. They are able to finance themselves, pay their bills, and everything like that, which is the smallest number of people having depend on their own. Now, 16% purely depends on pension, and you discover the 16% majority are the people who have been working for the government. These are the teachers, these are the nurses, and also and so on. Small private sector, because private sector has been trying to impress what you call pension. Now, I've talked about a income replacement ratio. As we continue having the same discussion, I hope we are able to reflect on the statement, how much you have saved as of today for your savings, and is very key. And maybe when you're taking notes or writing, an income replacement ratio is it means a person's gross pension after retirement divided by his or her gross income before retirement. So you can see the formula there. then the expectation is at least at 60% to 70 is encouraged. So this one is purely mathematics that you need to do on your own, and probably call for a meeting and see where are you so far. If you are to retire today, how much will you be earning or having as a source of income on your end without having to look for a job and start earning a salary as well. In terms of this, there's a graph that talks about interest rates. I want to confirm to you, this is an encouragement that with a saving of 5,000, it means in the next 30 to 40 years, you'll be able to have a good money of almost 3.1 M as a saving for your retirement. Now, allow me to dive deep in the retirement options that we have, and what options do you have and what suits you when that time of retirement comes. There are two options when it comes in terms of retirement. And remember, this means the money you are holding can be in a pension scheme, can be in a provident fund, can be in a saving somewhere, either in a fixed deposit, in money market, and it's a decision you need to make. Because you remember, in terms of retirement, you are having worked, is you need money to work for you. So as per my graph, I'll just be highlighting and pinpointing where you should focus and also look at it, the benefits that you have when you pick a specific choice. Now we have what we call pension. This one, for layman people call it an annuity. For other people in government calls a regular income that you are paid from the government, from treasury. So an annuity is a lifetime. As I've earlier indicated, it means that once you buy and must be bought from an insurance company, you are guaranteed that whatever happens, you'll be paid until you die. Now, under pension itself, and what we call a lifetime annuity, it means that once you come in, you'll be paid with that insurance company, can be insurance A, until you as a member die. However, on the same discussion, the annuity has various features. One feature, allow me to mention, is the feature that we call guarantee period. You discover when that time comes of retirement, you come when you have a one-on-one conversation, you have 0 to 20 guarantee period. So it's 5, 0, 5, 10, 15, and 20. So these are a fixed period. And just to mention about it is that you are guaranteed and you're protecting your next of kin, the people who will suffer most when you're not around. That's why when you are, whichever guarantee period you are picking is so much critical. And what we usually advise, where I sit as a consultant, is that look at your family. How many people depend on you in retirement? Is it only your spouse? Is it the pension baby? Or how many children are depending on you? And that will inform you which period you're going to take. Now, the 20-year guarantee period, it means that you have taken the longer and the maximum, and you have covered the next of kin for the next 20 years. Now, where we sit, just for your insight, is that if you outlive the 20-year guarantee period, as a member, it means that you'll continue earning, but your next of kin or your beneficiaries, you'll have already discharged them. If you take 0 guarantee period and something happens to you after signing off the annuity form, it means that the money remains with the insurance company. And that insurance company will invest and eat it on their own. You will not benefit your next of kin. So another thing in terms of the annuity, as I give some insights and highlights on an annuity, is what we call escalation. Escalation means increasing. As I highlighted on the same, it means we have 0 escalation, we have 3% escalation, and 5 up to a maximum of 10%. Now, it's so clear that on escalation, when you take 0 escalation, it means that there will be no increment on your monthly income until you die. If you take 3%, your money will be increasing as on a yearly basis. Then thereafter, up to the time you die. Remember, this escalation varies from escalation 0, 3 to 5 to 10. When you take 0, it's flat rate. When you take 3, it's increasing. Now, whoever takes 0, you will start on lower amount as a take home compared to person who takes 0. For 0 is a less risk, then that one goes forever. However, for the 3, it continues increasing on yearly basis until it comes to the person who took to 0. Just something to note from this same discussion: if you take 3%, you'll be on the same level with the person who took 0 on the 7th year. I'm just going to share with you how the matrix looks like so that you are able to appreciate the term of escalation. In terms of escalation as well, what makes you make a choice of which escalation is? One is the inflation, which will be able to resolve it. 2, in my same engagement with the client and our customer, is that we discover who takes escalation 3 or 5. They say at the time of retirement at age 60, they still have some energy. They are able to do some consulting. They are able to do some hustle. So they prefer taking 3 so that in the near future, their monthly income is growing by itself. So that when the 7th year, they have more, or when they go up to the 20th year in retirement, when now they have now fully retired, the money is able to work for them. Now, in terms of guaranteed, we have highly indicated payments are assured for a minimum period regardless of longevity. Another thing to mention about an annuity, we appreciate must be placed with an insurance company. And what does insurance do? It assures you that your money is safe and it will pay you until you die. Now, once you enroll for an annuity, please note, our take home is that you not come and say, please, this wasn't my choice. Allow me to get my money back. Once you join, you have joined, and that means you'll be that annuity until you meet your maker. Payments are made, you have to make one choice. One, you can either do monthly, quarterly, half yearly, or annually, depending on your financial needs. So in terms of an annuity as well, we have what we call annuities that can be single life. This one is you are member yourself buying. And remember, you are buying because you have a fund or you have a source of income. You have what we call joint life. This one you bring on board your spouse, you give details of your spouse, then we are able to give you a quotation on the same. Because again, we appreciate that in case the main member is gone, you're able to transfer the funds to your spouse. Then we have what we call deferred annuity. You can buy an annuity today, and you ask your advisors to tell your annuity provider that after 1 year, start paying me. Again, that will come with an interest on top of it. Then again, you start earning with the inclusive of your interest. In both lives, in case you die before expiry of guarantee period, please remember the balance will be paid to your next of kin. I have an illustration on my screen with a purchase price of $1 million. Remember, this is an assumption. You have retired as per the government law, retirement being 60 years. We appreciate that every employer, people retire on different age. There are those who retire at 55. There are those who retire at 70 years as lecturers. There are those who retire at 72 as judges and magistrates. So it's clear that if you have a purchase price is the amount you have saved. And you are appreciating this one can be both from provident fund, from a pension scheme, from your other savings. With a flat rate of 12%, you are more likely to take an annual annuity for a male of 124,200 is an annual, then an annuity monthly of 10,000. Remember, an annuity is guided purely on 3 things. 1, gender is key. 2, your purchase price. How much are you holding in your kitty? 3, your age. Because there's an assumption that the older you are, the closer you are going to meet your maker, and the lesser risk you bring to the insurance company. So all those are 3 factors that come a long way with it, and sorry, and are very key to all of us when you're making a choice. So all those ones are very key to us. Now, for you to purchase an annuity, by law, you must get a quotation. It means you must get first your age, you must know how much you're holding, you must know your gender, and thereafter you can discuss, will you wish to do your monthly to be paid on monthly or you want to be paid on annual. And on my screen, you can see the comparison. For the ladies, you receive less. I know it looks biased. However, there's an assumption that ladies tend to live longer and maybe you can do a survey in your village or your friends you have to know around. You discover that male die faster than female, but again, it's something for discussion. Now, the opposite of an annuity is what we call income drawdown. So friends, this one, as the term goes, income drawdown, you're withdrawing the income from your investment. And something to highlight is that it has a fixed term period with an insurance company of 10 good years. So once you buy, you must be an insurance company with an investment, with a fund manager for 10 good years. Then thereafter, you are free to either continue withdrawing from the fund, or you cash in, or you enroll back to an annuity where it is more secure. Now, when it comes to a debate, income drawdown or an annuity, just to mention, an income drawdown, I always believe, is for the risk takers, because the tail end, if you are over withdrawing the income and the income your fund manager is declaring is smaller, your fund may end up being depleted. So it's something you must measure it so clearly, in the sense that you must be withdrawing less money so that you don't end up depleting your fund before while you're still around. So some of the key features about an income drawdown is flexible. It means as a member, you're going to decide how much you want to be withdrawing. And remember, this income drawdown has a parameter from RBA that says you can withdraw up to a maximum of 12% on a monthly basis. So you as a member, you look at your budget and say, instead of withdrawing as per the RBA regulation of 12, you can opt to withdraw at 8 or less rate, considering that this is purely your money and you are the person who's carrying the risk. The opportunity also we have in terms of the annuity is a rollback of investment income. So this one is not like a transfer the risk to insurance company or for the annuity. This one, income will continue coming back to you under your kitty. So some members may not prefer insurance. We appreciate the diversity and have your choice to make on this one. Now, under income drawdown, you have a lot of transparency, because you usually get your annual statement and confirming how you have been performing. So RBA, the way I've indicated, it makes clear that you must be this income donor for 10 good years. You not reach a point and say, I purpose to be with you in 10 years, so I've opted now, allow me to withdraw back my money, so I have other obligation. By that, you'll be now breaking the law, and that one won't apply. As we have already indicated, an annuity, an income drawdown, you carry the risk. It has no guarantee return. It's affected by the performance of the economy. And like last year, the economy was good in terms of investment. We have a double-digit return. The other year, it was a negative. Then if it's a negative, it eats in your capital. If it's a positive, your capital goes up. So the challenge is that when it's a negative and you've been withdrawing, it means you have made an overdraft, you have overdrawn your funds. Then that means that you are at risk of having no income after 10 years or within the next 10 years. So the same thing about regulatory, income drawdown is supported by Retirement Benefit Authority, which is clear that initially before last year, you are allowed to withdraw up to a maximum of 15%, but currently the law has reviewed to 12% per annum. That's on annual basis. So which is very key in comparison with an insurance, with an annuity, where you have already transferred the risk. Now, what informs you which way? Now, for an annuity, if you discover that you have no other source of income and you are purely depending on annuity, where I sit as an expert, I will advocate for you purchase an annuity. Then your key role after you're buying an annuity is that is just to live, to just be talking to your God to give you more years to live. And then you'll be getting your money until you die. For an income drawdown, you must look at your budget. Is it the best? How much do you require? And are you able to absorb the risk? So for an annuity is for the risk-averse people. For income drawdown, I can mention is for the risk takers, because you don't know what might happen the following year. And the people who have another source of income, so that can be supplementing, and I can as well stop withdrawing the income and say defer my withdrawal to a certain period. Now, in terms of tax, I'm glad to mention, effective 27th December 2024, There are some tax relief which have been offered as compared previously. On pension taxation, the monthly take home, it used to be a maximum of 25,000. It was tax-free. Then the balance is applied on graduated scale. Now, where we sit with the current repeal and adjustment on Tax Act, any money you are accessing on retirement basis, it's tax-free. So it's a plus on our end for you to choose which model of retirement you want. So where we sit is a plus, and when you are in pension, and you have decided to opt for income drawdown or annuity, it gives you an opportunity to live longer and manage your expenses as you continue. And these are just revisions. Allow me to mention, if you have not gotten it, and the contributions currently for up to a maximum of 30,000 money you are remitting to a scheme is tax-free. Then when you are accessing, they have said up to a maximum of 20 years you have been in the scheme, you won't be taxed on withdrawal. And when you are retiring from a pension scheme, there's no tax because that money is assumed is tax-free that you have enjoyed. In terms of the Act of 2024 amendment, allow me just to mention, so that is very key as you also plan, and because I know as you plan to retire and options retirement that you're having, you're able to appreciate what the changes that has happened. As at December, 20,000 per month, amounting to 240, currently has moved from 20,000 to 30,000, meaning you have a tax relief of every year of 360 per year. That means that this is key to all of us in terms of tax allowable limit for contributions to a post-retirement medical fund. Allow me to mention this is something that has been introduced to make sure that we enjoy and make sure that most of us, as we join and we purpose to retire, we have a medical cover in place. We may not just depend only on pension saving. It's also good to save for your medical cover. And to that level, it has given us a room up to a maximum of 15,000 to save for post-retirement medical scheme. It means that this money, when you save, it will continue earning interest. As it earns interest, you'll be able again, when you leave service, to buy a medical cover either with a private insurance company or be able to have an opportunity to pay for the government, like for SHA and any other statute available. In terms of accessing the itself, please remember once you enroll for post-retirement medical fund, it's clearly that it will be towards your medical solution in retirement. Unless otherwise something happens, is whereby now you are able to be paid to your next of kin in case of death, and also when also it gives an opportunity in case you have saved from pension schemes to boost your post-retirement medical cover for that case. So these are just tax bands that are there when you want to access your money. We have what we call narrow tax band. This one is purely on resignation, and we have not been in a scheme for more than 10 years or so. For the wider tax band, again, we have heard about if you have been in a scheme for less than 20 years, again, there are those tax bands that are applicable. So just to mention, in summary, save consistency and consider doing additional voluntary contribution if you have that opportunity. Take full advantage of tax incentive available and avoid early access of your benefits. I know most cases, most of us have access to our benefits when we change employer, but ultimately, the purpose of pension scheme is to secure your old age. So when you change from one employer to another, does not give you room to access. But now this is encouragement that you are able to retain and also move with your pension to that new employer you're going to. Consider converting the full benefits into an annuity and income drawdown, as we have earlier indicated. Remember, in IDD prioritizes utilization of non-tax exemption, which I believe is a contribution over and above 30,000. Allow me also to mention, for some of us who are here and they are a member of a provident fund, the survey has been done that people who cash in everything under provident fund, up to 80%, they misuse the funds. So the encouragement is that you have opportunity under provident fund either to enroll or buy an annuity or go for income drawdown, which is the most ideal to assure you security in retirement. So having said that, allow me to stop there and get some questions, and I'll be able to respond. Then we can have more the discussion to that. Thank you. Back to you, Eve.
Thank you so much, Tony, for that insightful presentation. Ladies and gentlemen, it's now your time to raise your questions. You can raise your hand or type in the type the chat section. Let's have an engaging session. So type in your questions and we will respond. Good. I see the first question from Sarah Kano. Sarah Kano, good to see you here. Please share the example of the annuity with escalation option. Tony?
Thank you. Allow me to pull the screen. I can take the next question as I pull the escalation.
Ladies and gentlemen, it's your time. Do ask your questions. We're here for you. Any more questions? We have another question from David Mwangi. He's saying, taxation of contribution. When is the employer part of contribution taxed?
Thank you.
We have 19 minutes left to tackle your question and answers. Do ask them so that you may leave here with a clear mind.
Elizabeth, I suggest let us have the question first as I pull the escalation from a machine.
Yes, please. Members, do ask your questions. You can also raise your hand and we'll be able to hear you. Thank you again. Sarah, kindly elaborate more on the post-retirement medical fund, and does Octagon offer this? Thank you, Sarah, for that question. Is there something you would wanted? Is there something you would have wanted to hear and you've not heard about it? Also, let us know. Are you satisfied with the presentation? Let us know. We want to hear from you. Esther, Evans, James, Lena, Martin, Mary, I hope you're doing fine. I hope you're satisfied with the presentation. Would love to hear from you. Don't be silent. Tabitha, Virginia.
Please confirm if you're able to see my screen.
It's loading. Yes, I can now see your screen, Tony.
Thank you. This one is as per on the escalation that you had asked about. Now look at my screen. That is a member with the 6.5 million. When you look at it, you have is a single life annuity that the one that I earlier indicated of a member who has decided to buy for himself a retirement solution. So you can look at it on my far left where we mentioned about 0% escalation. So for that member, assuming this member is picking zero escalation, and he has decided to pick 20 years guarantee period, he will take home a flat figure of 63,017 for the rest of his life as a member. So after 20 years, he will have already discharged the beneficiaries, and him or her will continue earning 63,000 until he dies. Assuming you decide to take 3%, you discover for the same 20 years, you will start at 50,000. Then on an annual basis, to be increasing by 3% for the rest of the member's life. The same applies to the 5% escalation. So you start at 60, you start at 43,519, then it will increasing on 5%. Then it starts across even on 10 years, 5 years, even on no guarantee. So this is what is going to guide you basically how much do you require and how many people will purely suffer in case you're not around. Now you can look at, let us say your budget, your take home, you're looking at a budget of 68,000 or 60,000. So you might opt for 10 years. Now at that 10 years, you may look back and say, how many people depend on you or depend on me so much. Again, that will be a key guiding factor. How do you move from there? So this is purely the escalation and the guarantee period. Now, assuming you have taken 20 years and you die after 5 years, the insurance company will compute the 15 years. So it will be 63,000 times 12 times 15 years, and you'll be paid to your next of kin, either as a lump sum or as a monthly income for them until the 15 years are exhausted. So the only challenge is for the people who take no guarantee, which we call zero guarantee. It means that these people, in case something happens to them, their money goes that way. I believe I've answered that question on the escalation, and I've gone also further to talk about the guarantee period. So the next question was on
Sorry, Tony, before you go to the next question, Sarah Kano had asked that first question, and I see her hand is up.
yes.
Sarah, I don't know, you can unmute yourself and ask your question. Okay, she says she's all good. Thank you.
Okay, thank you, Sarah, and we are glad for that question. I believe it explains clear. The other question was on taxation of contribution. When is the employer part of the contributions taxed? Now, allow me just to mention, in pension administration and taxation, employee is given preference, meaning all contributions that are made to a scheme, when we are allocating as per the regulation, we start with the employee. So assuming an employee has a contribution of 10,000 to a scheme, and the top up from employer is 20. So let us say 20 employee for easy understanding and elaboration, then employer giving 20. It means the first 20 we allocate on the employee, then we take 10 from employer to top it to make it 30. Then the 10,000 that remains to be taxed. Now the employer will make a provision when they are making financials for that case. So it means so clear that that's where employer comes in terms of tax. But when you're making contributions to a scheme, employees given preference, and that's why when in the old regime, when you are retiring, you have a contribution to call registered, that those contributions were to be taxed on graduated scale when you retire from employment, compared to the current regime that has suggested that having been a scheme and you're retiring from a pension scheme, there's no tax on your money. I've seen, kindly elaborate more on post-retirement medical fund, and does Octagon offer this? As earlier indicated or mentioned, is that a post-retirement medical fund is a solution or a product that has been approved by RBA that allows you as employee to save via the current scheme. So what you just need to do is to write a letter or an email to your HR requesting kindly deduct this amount to go towards a post-retirement medical fund. And the HR, when they are deducting, they will advise us as your administrator or your provider, this money goes to post-retirement medical fund. And when it comes, you have a two set of benefits, one for retirement and two for post-retirement medical fund. Now, Octagon will offer this solution. Once you are retiring, you will be able to engage you on that basis and tell you, you transfer this post-medical fund to this account where we'll be able to be purchasing for you an annuity and also make sure that you get a cover from a reputable insurance company. So you are able to continue saving. In terms of how do you plan to have a physical member training, member education? I wish to know the organization so you can organize. However, you can get in touch with us. We should have a physical training here at our office in case you need it. So you can get in touch with my colleague Elizabeth, and she'll be able to tell you when we'll be having this training.
Thank you so much, Tony, for that. In regards to what you've spoken about, I see another question. Ivan says, I would like to understand more on this. If I have been in a, I'd like to understand more of this. If I have been in a scheme for more than 20 years and withdraw the benefits, is it tax-free?
Thank you, Evans. With the current regime, effective 27th December 2024, if you have been in the scheme for 20 years and you are retiring, there's no tax. But if you have been in the scheme for the last 20 years and you have resigned, that 50% as per the law won't be taxed. So there's no tax at all.
There's another question from Sarah. She's asking, what if I have a personal pension scheme? How does the post-retirement medical fund work?
Thank you, Sarah. This is easy. You just need to drop us an email and advise us that the money you'll be saving through the personal pension scheme, you want to incorporate post-retirement medical fund. Then you'll be saving two sets of contribution. You have one that goes as a normal pension. Then the other one you'll be setting aside for medical purposes. So that one you just need to drop us an email and be sending both two arrangements. So we'll be able to allocate once we receive the fund as per your advice.
Thank you, Tony. We have another one from David Mwangi. He says, I'd love to have a one-on-one on the matters of taxation. And he also has a concern that needs further clarification. So he's asking, how can he reach out to you? And James had asked, can a member who has not reached retirement age purchase annuity or income drawdown?
Thanks, James. An annuity is advised that you must purchase it at when you clock 50. So the early retirement is allowed at 50. I'm assuming when you are doing early retirement, it's coming from other source of saving. If in case it's coming from pension, remember you have to separate from your employer for you to access your retirement saving for pension. So it's allowed at 50, being the earliest. Then this one must be coming from other source. But in case you want to use your pension saving, please remember you have to leave your employment. Then you do early retirement. Then you'll be able to purchase income drawdown or an annuity for that case. How to access me, David? I think I'll provide my number. You can pay us a visit here at our office at West Park Suits, and I'll be able to engage you and also guide you and the best option. So that one, Elizabeth will guide. The next question from Esther, if your total contributions to a person is around 8 million, by the time you retire, how do you estimate your monthly income in case of an annuity on retirement? Now, in case you have 8 million, for easy computation, for an annuity can be a flat rate. That's used for a flat rate will be like 10% of that, which means on 8 million, will take home 80,000 for the rest of your life. But again, we have other parameters depending on the gender, your age, and now having the 8 million. But down that one, we can engage to discuss after this meeting, and we can give you a quotation just to see which scenarios are best for you. Thank you.
Thank you, Tony. David will be able to reach out to you with the information you provided when you registered for this. My colleague Eve, has given out our contact information where you can reach us through. Also, Tony, I would love you to touch on Octagon Insurance Brokers.
Thank you, Elizabeth. Allow me just to highlight two other products that we offer. As Octagon Africa Financial Services, we offer insurance brokerage solution. What does that mean? We will come in as an intermediary to give you advisory, which covers are you able to buy. We'll be in a position to negotiate for you a competitive return for various products. For various products that we involve in ourselves is motor insurance, which will come and make sure that we can negotiate to a rate of 3.5. And in case of a claim, as Octagon Africa will be able to intervene and make sure that your car is repaired promptly. And in case of having to look for, having to get what we call a replacement, a courtesy car, Octagon Africa will be able to harm and support you. In terms of also on in general insurance, we have also what is called Work Injury Benefit Act, WIBA. Since you have been licensed with the Insurance Regulatory Authority, we are able to engage all insurance companies in Kenya which have been registered to operate and run a business. As Octagon Africa, we'll be able to run with it and make sure we negotiate. We have tailor-made product where we sit, whereby it goes over and above the normal product that's offered on the market. What does that mean? As Octagon Africa, we are able to bundle the product. Allow me to mention the product that has been bundled together just from the normal statutory. One of the statutory products that run in Kenya is what we call Work Injury Benefit Act. This one was established by Parliament and passed. All employers in Kenya must have this to cater a benefit to the employees they get injured. Now, as Octagon Africa, we partner with other insurance company in Kenya, we are able to offer what we call a combined solution. What does that mean? A combined solution means you are able to negotiate and say, for this cover, let it cover group life assurance. Now, group life, what is group life assurance? Group life assurance is a promise that in case an employee suffers or dies, the beneficiaries are paid triple of their salaries. Can be 3 times, can be 2 times, can be 4 times. For that case, as we bundle together, it means that group life assurance, group personal accident, and WIBA, this member is covered all round. Just to mention, for some of us, for your clarity as well, is that WIBA only covers you when in your workplace alone. Now, when we extend to group personal accident, it means covers you everywhere, even on road. Now, when you add group life, it means that you are able, in case you are to die, allow me to say, you are to die naturally, you are given even 3 times of your annual salary. But in case you are to die from natural death, as per the, from accidental, the WIBA talks about 8 times of your annual earnings. So this is why we say you have extended the cover if you are to do a combined solution. Then we also extend our covers to what we call, you can also, under our brokerage, we offer domestic package, and we are glad to engage you on the same note. Another product we offer as Octagon Africa is what we call trust fund management. We appreciate that God might call you home anytime and may have minor children. And there's no need for you leaving this money to your to the grandchildren of your children, or leaving to your uncles or whoever. As Octagon Africa, we are able to come in to make sure we invest this money for you, and be able to pay school fee for your children until they reach age of majority. What we just require is an engagement and a signing up, and also know who is the guardian of the children. And the fees will be paid direct to the children school, and in case of upkeep, will be paid to the guardian instead of transferring the millions you have saved to the guardian who might end up misusing the funds. So those are the very key things we do. And additionally, we do the training, which is very dear to our heart, both being financial literacy, financial planning, and conferences, which I will be very glad to work with you on the same.
We have a last question from Esther, who wants you to comment on education or endowment policies with trustees.
We have Evans. I kindly request you share, that one will be shared after this meeting. On education or endowment policy, allow me to start with education. Education currently is a necessity, is key to our children that we have them. So having this education policy is protecting them in case something were to happen to you as a breadwinner. Now, on education policy, we have various factors. First and foremost, we will require what is your target. All of us, we appreciate that if you are a parent, you'll want the best for your children. It means that we might estimate the education cost of your child. For some, we may say for the entire education from high school to university or any further education, you may require 2 million. So that would be the goal towards saving. Now, on that level, we require to know the age of the person who's going to save for that education policy, the age of the child, because it's very key to know when the child will start utilizing the funds, and also to know when you want to start utilizing. There are those who prefer to use the funds in high school. There are those who prefer using the funds in university. And remember, for education policy, you don't need to have the child. You may wish to save because it's an investment tool for you. And also, just to mention, there's also tax relief when you are paying from the payroll. You get an exemption from insurance, AKI. Then from there, you'll be able to give your finance to get a tax relief. So in terms of endowment policy, this one also varies with your goal. There are those that endowment lasts for 10 years, 20 years, and also that one again will be able to engage you to know how much premium you'll be paying. Maybe Esther, this one we can get your contacts. I'll reach out to you so that we're able to discuss further to know how much you'll be able to save. Will it be education for starting at high school, be it starting at university, and at what level we want to save, and also looking at your age factor, which you come to play. Thank you.
Thank you so much, Tony, for that wonderful question and answer session, and also that wonderful training that you've given us. Thank you also, members, for joining our training today. We hold these trainings each and every month, so be on the lookout on our communication channels to see what other training we'll have next. In case of anything, Eve has posted our contact information, so you can be able to reach out to us, and we're here to assist you in any matter that you have. So once again, Tony, thank you very much. We would love to have you here again. Sarah says it's a very useful session. Thank you so much. So thank you, members. I wish you a lovely Friday and a lovely weekend. See you on the next one. You can catch this training on our YouTube channel. So you can be able to go through this again, and we'll also be able to share the presentation with you on email. So thank you and God bless you.